It's Small Stakes Beginner Edition. What are futures? Let's start out from the letter A. You don't learn the alphabet, Mikey, in like F or M or P or any of those other letters. We're going to start out with A with the Small Stakes Beginner Edition. What are futures? We're going to do the textbook definition. We're going to give you the definition that you actually need. And then we're going to tell you why the hell you should care about what futures are and how you can use them. Let's start with that textbook definition. Mikey, why don't you take it away, man?
Sure. I'm just going to read right off the slide here because it's in front of me. That's the textbook way. We'll keep it old school and follow like my college professors, put a presentation on the board, read right off the presentation. Terrible way to teach, and then we'll show you the fun small stakes way of understanding the future. So futures are agreements to buy or sell an asset at a specified quantity and date in the future. They are standardized contracts to either receive or deliver some underlying commodity at a fixed point in time. What does that mean, Frank? Why don't you break it down in actual layman's terms?
I mean, this old definition that you get via Google and some other places, the best way to describe it is with an old school example. Like futures were created for farmers of rice, farmers of corn, and so many other commodities to essentially say, hey, I'm going to have this thing in a couple of months from now. Why don't we lock in a price for me to sell it to you right now? I'll deliver it. You being entity that's going to sell the rice to, consumers or cook the rice or do whatever, and also goes for corn and wheat and so many other commodities. Let's decide upon a good price here in, let's say, January, February, March. And then when I get to actually pull the stuff out of the ground in the summer and fall, we'll already have established that price, and any volatility between now and then in the crop that I'm growing, maybe I have a lot more of it than I thought, and that price should have dropped down. Well, I already locked in that price in January, February, March. Oh, maybe some kind of drought occurred and I have less of that crop and the price should have skyrocketed. Well, you, the person who wants to buy it, have already locked in that lower price, so you don't have to take on that risk. That's what these were created for. And that's why you have this old school definition of it's an agreement to buy or sell the thing, and it's a specified quantity, and it's you have to be ready to deliver the asset or receive the asset on that day. You'll see what we use them for today, not really having anything to do with receiving or delivering any commodities or financial instruments. But that kind of makes sense, right, Mikey? Where it's like, all right, on the third Friday of the month, if I bought this contract, this futures contract, then I am getting ready to receive that asset that the future is on. And if I sold that contract on that third Friday, I better be ready to deliver it, to hand it off to the person who bought it. I mean, is that all making sense so far?
Absolutely. And I think keeping it in the world of agricultural products and commodities makes it much more tangible. Yeah. As you mentioned, the origin story relates back to rice farmers in Osaka, I believe, and they were worried about weather conditions. So that's the easiest way I find to keep it in your mind, is that you have some underlying commodity and you're just agreeing to a price to buy or sell that commodity at a certain date and time.
Yeah, let's bring it into at least closer to where we are here today in 2021, because essentially futures are just a leveraged way for you to access commodities and securities like stocks and foreign exchange products, currencies, and interest rates and all of that fun stuff. Because here's the deal. If I bought that future on rice, then I would benefit theoretically if that price of rice went higher. If I had sold you that future on rice, then I would have benefited if that price went lower. And I don't want people to think too hard about that concept, but if you do want to go all the way down that path, you can think about it as all right, if I did sell that, if I am the rice farmer and I sold that rice future at a price of 10, and the price, because there was a really good harvest, we had way more than we thought, the price should have actually gone down to 9 or 8 or 7, then that's when I really made my money, right? Because I'm locked in here to sell it at 10 and it's down here at 8 or 7 or where it would have gone. Same from the reverse. But we don't even have to go that deep, Mikey, because if I buy a future on, say, crude oil, like the SMO futures offer, I want it to go higher. If I sell it, I want it to go lower, and I get to do so in a leveraged way. That's pretty simple.
Absolutely. It really is, doesn't get any more straightforward than that. There's no, it often felt like when learning futures, I had to figure out this call put thing again, and this buy, sell, buy, call, sell, put, et cetera, like trying to mix and match all those combinations. Outright futures, your only available trades are buy and sell.
Yep.
There are calendar spreads, but we're not going to talk about that today. You buy a future if you think the price is going to go higher. You sell the future if you think it's going to go lower, and you profit if it moves in the direction you expect.
Yeah, and the question becomes like, well, why the hell do I care about this? Like, why am I wasting my options? Yes, they're more complex than futures, but that complexity involves like, oh, if I sell an option, I can get theta decay. Or if I buy an option and volatility goes up, I get paid via Vega and all these different things. Futures are simpler. If I buy it, I want it to go up. If I sell it, I want it to go down. Why bother? Why not just go to crude oil? Why not just go to the S&P 500 ETF? And the answer becomes, well, futures let you buy or sell with the same reduced cost relative to stock. You're going to put up, if you're buying crude oil futures, you're going to put up somewhere between 1% and 50%. Right now, I think sitting around like 10% of what that commodity is actually worth to trade it. If you're going to trade ETFs on crude oil, you're going to put up 50 to 100%. And what's really nice, Mikey, is you have the ability to short or sell these markets with ease, so much ease that it's actually just the same amount that you pay to buy it. And that goes for stock futures, that goes for foreign exchange futures, interest rate futures, other commodities like gold and silver and agricultures like we talked about. It's essentially just like, why bother with futures? Well, because it's cheaper and it's easier for me to trade very quickly.
Absolutely. I think that is the biggest selling point of futures. There are other benefits, but the biggest one is just this capital efficiency and the idea that it's a levered product. If you want to buy $100 worth of stock exposure, you're putting up $100. If you want to buy $100 worth of stock exposure with a future, you're probably putting up $5, $10, $15. So a much better use of your limited capital when you're trying to gain exposure on a specific market. And futures tend to cover the commodity world much better than the stocks and ETF equivalents would.
I love that analogy there, Mikey. That's actually really perfect. It's just like, simply put, there's $100 stock or just $100 market out there, and I want to buy or sell it. And if I have to do so in stock, I probably have to put up $100 to buy it. And if I want to sell it, there might be some hard to borrow regulations, so many other things on that it might be even more expensive than $100. In futures, you can buy or sell it for the same amount. And also that amount is usually going to be considerably less than what you'd have to put up there. And this lends itself very well to short-term speculation. This is where a lot of futures come in from speculative or hedging reasons as well. You know, you anticipate a down day in the stock market and you just want to speculate on that. You can go to the futures and sell it for a low cost and no real regulations to go out there and short the stock market. And you can buy it back really, really easily. If you just want to speculate on that, or you have a long stock portfolio, Mikey, and you want to just hedge part of that for today or this week or this month, you can go in there and sell the futures and do so at a low cost and not really break your bank to put that hedge on. Same with, just trading crude oil. You think crude oil is going lower because X, Y, and Z. You can sell it and buy it back relatively quickly. There are so many other uses that we'll get into in the future, but I think that we nailed it for the most part, what futures are, what they can afford you, and why people use them here on the Small Stakes Beginner Edition, episode 1. So thanks so much for joining me, Mikey. It's been a fun one. What do you think?
Yeah, thanks for having me. And if you guys have questions about any of this content, never hesitate to reach out. We're on Twitter @SmallExchange. or you can just email us directly. I'm michael.gough@thesmallexchange.com, and you are frank.caberna@thesmallexchange.com. So please, if you do have questions, don't hesitate to reach out.
Absolutely, man. Thank you so much for wrapping things up with those contacts. Yes, everybody definitely reach out as you learn more about futures. It's a fun ride, especially with the small products, tend to be smaller in size, as you might imagine, and thus less risky than those big traditional futures. So a great training ground, so to speak, for trading. This has been a great training ground here in this segment, Mikey, but I must bid you adieu because the big boy is coming here to play. Splash into Futures is coming up next. Enough of the education, time to put it into practice. We're going to fire off a bunch of futures trades coming up next, everybody. Thanks for watching.